A cold winter morning in 13th century London, and a desperate mother clutches her last valuable possession, a silver brooch passed down through generations. Her children haven't eaten in days, the harvest failed, and her husband lies ill. Where does she turn when survival hangs by a thread? Not to a bank, those don't exist yet for common folk. Instead, she walks down a narrow cobblestone street toward a shop marked with 3 golden spheres, where a Lombard merchant waits behind a wooden counter. This single transaction, this seemingly simple exchange of precious metal for coins, represents one of history's most crucial yet overlooked institutions. Medieval pawnshops weren't just businesses. They were lifelines that kept entire communities breathing when the world seemed determined to suffocate them. Before we start, consider subscribing to the channel. So settle in as we journey into a world where your grandmother's wedding ring could mean the difference between warmth and freezing, where a craftsman's tools served double duty as both livelihood and emergency fund, and where Italian immigrants revolutionized how ordinary people survived extraordinary hardships. These weren't the pawnshops of stereotype and shame, but sophisticated financial institutions that operated when kingdoms had no welfare systems, and survival meant creativity, courage, and sometimes a small loan secured by whatever precious thing you owned. Chapter 1: Pawnshop Origins. What if I told you that the very concept of emergency financial help, the idea that you could walk into a building and walk out with money to save your family, began not in modern banks or government offices, but in the hands of people who were often despised by society? Before we understand how pawnshops saved lives, we must first understand how they came to exist at all. The story begins not in England, but across the Channel, in places where survival had already taught hard lessons about the value of second chances. Ancient civilizations had their own versions of collateral lending, but the medieval pawnshop, as England would come to know, it emerged from a perfect storm of religious restriction, economic necessity, and human ingenuity. In the early medieval period, the Catholic Church held an iron grip on financial matters through its usury laws. According to canonical law, charging interest on loans was considered a mortal sin, equivalent to theft from God himself. The reasoning was both theological and practical. Money was seen as sterile, unable to reproduce itself naturally like crops or livestock, so demanding more in return than what was lent violated divine order. This created a fascinating paradox. People desperately needed credit to survive, but the dominant religious authority forbade the very mechanism that could provide it. The Italian immigrants, particularly those from Lombardy and other northern Italian states, who had been quietly revolutionizing finance in their homeland. These Lombard merchants brought with them centuries of experience in banking, trade, and most importantly, creative solutions to the usury problem that plagued Christian Europe. The Lombards approached pawnbroking with a sophistication that transformed it from a marginalized necessity into a respectable business practice. They understood that the key to success lay not in defying church authority, but in finding ways to work within its constraints while still providing essential services. Rather than charging explicit interest, they might structure transactions as purchases with options to repurchase, or build interest into exchange rates and fees in ways that satisfy canonical requirements while still generating profit. By the 13th century, Lombard pawnshops had established themselves throughout England, often concentrated in areas that would become known as Lombard Street in London and similar districts in other major cities. These weren't the dingy, desperate establishments of later stereotype, but often respectable businesses that served clients ranging from struggling artisans to wealthy merchants who needed temporary liquidity. The Lombard approach to pawnbroking introduced several innovations that would echo through financial history. They developed standardized procedures for evaluating different types of collateral, from jewelry and precious metals to textiles and tools. They created systematic approaches to storage and security, ensuring that pawned goods remained safe and properly cataloged. Most importantly, they established networks of interconnected shops and agents that could share information about customers, coordinate large loans, and manage risk across multiple locations. What made the Lombard system particularly revolutionary was its accessibility to ordinary people. While earlier forms of credit had primarily served the wealthy and powerful, Lombard pawnshops accepted small items of relatively modest value, making emergency credit available to craftsmen, small traders, and even agricultural workers who owned little more than their tools and household goods. This democratization of credit would prove crucial during the frequent crises that characterized medieval life. The physical appearance of these early pawnshops often reflected their owners' ambitions for respectability. Rather than operating from basements or back alleys, successful Lombard pawnbrokers frequently occupied prominent locations on busy commercial streets. They adorned their shops with the 3 golden spheres that would become the universal symbol of pawnbroking, a mark that derived from either the coat of arms of the powerful Medici family or, according to legend, from the 3 bags of gold that Saint Nicholas used to save 3 poor sisters from destitution. The interior of a typical 13th or 14th century Lombard pawnshop would have been a fascinating blend of commerce and security. Heavy wooden counters separated customers from staff, while sturdy iron chests and reinforced storage rooms protected valuable collateral. Account books recorded each transaction in careful detail, noting not just the item pawned and amount lent, but often personal information about the borrower that would help prevent fraud and ensure proper redemption of goods. But the real innovation of the Lombard pawnbrokers lay in their understanding of their customers' needs. They recognized that people seeking pawn loans were typically facing emergency situations where speed and convenience mattered more than optimal terms. Accordingly, they streamlined their procedures to allow quick evaluation and immediate payment, often completing transactions in minutes rather than the hours or days that might be required for other forms of credit. This customer-focused approach extended to the terms they offered. While pawn loans typically carried higher interest rates than other forms of credit, they also offered unique advantages that made them attractive to borrowers facing urgent needs. Unlike other loans that might require co-signers, proof of income, or extensive documentation, pawn loans required only the collateral itself. The borrower's creditworthiness, social status, or personal reputation were irrelevant as long as the pawned item had sufficient value to secure the loan. The legal framework surrounding pawnbroking also evolved during this period. as local and royal authorities recognized both the benefits and the dangers of the industry. Regulations emerged governing everything from maximum interest rates to procedures for selling unredeemed pledges, creating a standardized system that protected both lenders and borrowers while ensuring that pawnshops could operate profitably. Perhaps most importantly, the early development of pawnshops established them as institutions of last resort, places where people could turn when all other options had failed. This role would prove crucial in the centuries to follow, as wars, plagues, famines, and economic disruptions repeatedly tested the survival skills of medieval populations. The pawnshop offered a unique form of financial insurance, allowing people to convert their possessions into emergency funds when disaster struck. As we've seen, the origins of medieval pawnshops were neither simple nor straightforward. They emerged from a complex interplay of religious restriction, economic necessity, and cultural adaptation. But understanding their origins is only the beginning of our story. To truly appreciate how pawnshops saved lives, we must examine the intricate systems they developed for providing credit to people who needed it most. Chapter 2: Loan Systems. Now that we understand how pawnshops came to exist, we must explore the ingenious mechanisms they developed to actually provide loans, because the devil, as they say, lies in the details. And the details of medieval pawnshop operations reveal a world far more sophisticated than modern stereotypes suggest. Imagine walking into a Lombard pawnshop in 14th century London. The first thing you'd notice isn't chaos or desperation, but order. Behind that heavy wooden counter sits a clerk who's part appraiser, part accountant, and part psychologist, trained to evaluate not just the monetary worth of your possessions, but your personal circumstances and likelihood of redemption. This wasn't casual money lending. It was a refined system that had evolved over generations to serve people in crisis while protecting the lender's investment. The foundation of any pawn transaction was the collateral itself, and medieval pawnbrokers had developed remarkably sophisticated methods for evaluating the bewildering variety of items that crossed their counters. Unlike modern pawnshops that might specialize in electronics or jewelry, medieval establishments needed to assess everything from religious artifacts to agricultural tools, from exotic textiles to ordinary household goods. For precious metals and jewelry, Lombard pawnbrokers employed techniques that wouldn't look out of place in a modern assayer's office. They used touchstones and acid tests to determine the purity of gold and silver, employed precision scales to measure weight, and maintained detailed knowledge of current market prices for different types of precious items. A gold ring, for instance, would be evaluated not just for its weight in precious metal, but for its craftsmanship, style, and potential resale value should redemption fail. But precious metals represented only a fraction of medieval pawn transactions. Far more common were the everyday items that comprised the material wealth of ordinary people. Textiles, particularly fine wool cloth, represented significant value in an economy where most clothing was homemade and quality fabric was expensive. A pawnbroker needed to distinguish between different grades of wool, recognize valuable dyes, and understand the regional variations in textile production that affected value. Tools and equipment formed another major category of pawn collateral, reflecting both the economic reality of medieval life and the personal desperation that drove people to pawn shops. A carpenter's chisel set, a seamstress's needles, or a farmer's plow represented not just monetary value, but the means of earning a living. Pawning such items was often an act of profound desperation, indicating that immediate survival took priority over future income. The evaluation process itself was a delicate balance between speed and accuracy. Customers seeking pawn loans were typically facing urgent financial crises that demanded immediate resolution, but hasty appraisals could lead to losses for the pawnbroker or disputes with customers. Experienced pawnbrokers developed the ability to quickly assess both the intrinsic value of an item and its marketability should sales become necessary. Once an item's value had been established, the pawnbroker faced the crucial decision of how much to lend against it. This calculation involved multiple factors beyond simple market value: the condition of the item, its likely durability during storage, seasonal fluctuations in demand, and the costs of eventual sale all influenced the loan amount. Most pawnbrokers followed general rules of lending between 1/3 and 2/3 of an item's assessed value, providing a cushion that protected against market fluctuations and storage costs. The interest rates charged on pawn loans reflected both the convenience they offered and the risks they entailed. These rates were typically much higher than those charged by other lenders, often ranging from 20 to 40% annually, but they came with advantages that justified the premium. Unlike other forms of medieval credit that might require months of negotiation and extensive documentation, pawn loans were available immediately. Unlike debts that could destroy a borrower's reputation and future creditworthiness if unpaid, pawn loans were entirely collateralized, meaning default had no consequences beyond loss of the pawned item. The typical loan period varied by location and custom, but most pawn loans were structured as short-term arrangements lasting anywhere from a few weeks to a year. This reflected both the emergency nature of most pawn borrowing and the practical limitations of storing large quantities of diverse goods. Customers could typically extend their loans by paying accumulated interest, but the system generally encouraged quick redemption rather than long-term borrowing. The actual transaction process was governed by elaborate procedures designed to protect both parties and create clear legal records. When a customer brought an item for pawn, the clerk would first examine it carefully, often in full view of other customers, to prevent later disputes about condition or authenticity. Once a value and loan amount were agreed upon, the details would be recorded in the shop's ledger, typically including the customer's name, address, a detailed description of the item, the loan amount, the interest rate, and the redemption deadline. The customer received a pawn ticket, a small document that served as both receipt and claim check. These tickets became a form of currency in their own right, as they could often be transferred to other people who could then redeem the pawned goods. This transferability turned pawn tickets into an early form of negotiable instrument, contributing to the development of more sophisticated financial markets. Storage of pawned goods presented ongoing challenges that medieval pawnbrokers solved with impressive ingenuity. Valuable items were secured in iron chests or locked rooms, while bulkier goods might be stored in warehouses or even left with the borrower under specific conditions. Some pawnshops developed intricate numbering systems that allowed them to track thousands of individual items, while others specialized in particular types of collateral that could be stored efficiently. The redemption process was equally systematic. Customers presenting valid pawn tickets would pay the loan principal plus accumulated interest to reclaim their goods. The pawnbroker was legally and morally obligated to return exactly the same item that had been pawned, leading to elaborate identification systems for similar goods. Some shops used distinctive tags or markings, while others relied on detailed written descriptions that could distinguish between nearly identical items. But what happened when loans weren't repaid? This was where the pawnshop system revealed both its practical advantages and its human costs. Unredeemed pledges became the property of the pawnbroker, who could then sell them to recover the loan amount plus interest and costs. This process was typically governed by local regulations that specified minimum holding periods and sale procedures designed to maximize recovery for both lender and borrower. The sale of unredeemed pledges created a secondary market that benefited the broader community while providing crucial income for pawnbrokers. These sales offered opportunities for people to purchase goods at below-market prices, from everyday necessities to luxury items that might otherwise be unaffordable. For the pawnbrokers, pledge sales provided the profits that made their businesses viable, as the interest on redeemed loans often barely covered the costs of operation. Medieval pawnshops also developed sophisticated risk management techniques that wouldn't be out of place in modern financial institutions. They diversified their loan portfolios across different types of collateral and customer bases to reduce exposure to particular market sectors. They maintained relationships with other pawnbrokers and merchants to share information about fraudulent customers or stolen goods. Some even developed early forms of insurance, setting aside reserves to cover losses from theft, fire, or other disasters. The customer base of medieval pawnshops was far more diverse than might be expected. While poor people facing emergencies certainly formed a core clientele, pawnshops also served merchants needing temporary liquidity for business opportunities, travelers requiring local currency, and even wealthy individuals who preferred the convenience and privacy of pawn borrowing to the complexity of other financial arrangements. One particularly interesting aspect of medieval pawn lending was its seasonal nature. Agricultural communities experienced predictable cycles of plenty and scarcity that created regular patterns of pawning and redemption. Items might be pawned after harvest to pay taxes or debts, then redeemed before the next growing season when they would be needed again. Pawnbrokers learned to anticipate these cycles, adjusting their rates and policies to accommodate the rhythms of agricultural life. The legal status of pawnbrokers also influenced their operations in important ways. As essentially unregulated businesses in the early medieval period, they enjoyed considerable freedom in setting terms and conditions. However, this freedom came with risks, as they had little legal protection against fraud, theft, or political persecution. The gradual development of regulatory frameworks provided more security for pawnbrokers while also imposing restrictions on their practices. Perhaps most remarkably, medieval pawnshops developed systems for dealing with customers who couldn't read or write, which included the majority of their clientele. Visual identification systems, standardized procedures that could be explained verbally, and trusted intermediaries helped ensure that illiterate customers could navigate the pawn process safely. Some pawnbrokers even developed reputations as informal literacy instructors, teaching basic reading and arithmetic skills to regular customers who needed them for business purposes. The social dynamics of pawnshop transactions were equally complex. While financial desperation might drive someone to pawn their possessions, the transaction itself required careful negotiation between parties with very different levels of power and information. Successful pawnbrokers learned to balance firmness in business matters with empathy for their customers' circumstances, building reputations that encouraged repeat business while maintaining profitability. As we can see, the loan systems developed by medieval pawnshops were far more sophisticated than simple collateral lending. They represented comprehensive approaches to risk management, customer service, and community finance that reflected centuries of practical experience and innovation. But to truly understand their impact, we must examine how these systems functioned within the broader economic structures of medieval England. Chapter 3: Economic Role. Here's a question that might surprise you. What did medieval England's economic system have in common with a modern emergency room? Both operated on the principle that survival sometimes required immediate, expensive intervention that couldn't wait for ideal circumstances. And just as hospitals serve as safety nets for medical crises, pawnshops served as financial emergency rooms for a society that had no other institutional mechanisms for dealing with sudden economic disasters. To understand the true economic role of medieval pawnshops, we must first appreciate just how precarious life was for ordinary people in 13th through 15th century England. This wasn't simply a matter of being poor by modern standards. It was about living in a world where a single bad harvest, unexpected illness, or political upheaval could destroy families and entire communities within months. Consider the economic realities facing a typical English family in this period. Perhaps 90% of the population lived in rural areas, dependent on agriculture for survival. A small farmer might own a few acres of land, some livestock, basic tools, and household goods that represented the accumulated wealth of generations. But this wealth was almost entirely illiquid, tied up in assets that couldn't be quickly converted to cash when emergencies arose. When disaster struck, and it struck regularly in medieval England, people faced impossible choices. A crop failure might leave a family without food or seed for the next season. A lord's demand for military service could take away the primary wage earner just when his labor was most needed. A merchant's business reversal could destroy years of careful accumulation in a matter of weeks. Traditional solutions like borrowing from neighbors or seeking help from the church were often inadequate for serious crises, either because the entire community was affected or because the assistance offered was insufficient to address the underlying problem. Into this dangerous void stepped the pawnshops, offering something that no other medieval institution could provide: the ability to convert physical assets into immediate cash without selling them permanently. This seemingly simple service had profound implications for economic stability and social survival that extended far beyond individual transactions. At the most basic level, pawnshops provided liquidity to an illiquid economy. In a world where most wealth existed in the form of land, livestock, tools and household goods, the ability to temporarily convert these assets into money offered unprecedented flexibility. A farmer facing a poor harvest could pawn his best plow to buy seed grain, then redeem it in time for the next planting season. A craftsman whose workshop had been damaged by fire could pawn his family's jewelry to purchase new tools, then work to earn enough to reclaim them. This liquidity function was particularly crucial during the frequent monetary crises that plagued medieval England. The kingdom's money supply was entirely metallic, consisting of silver and gold coins whose availability fluctuated wildly based on mining output, international trade, and royal policies. During periods of monetary shortage, when actual coins became scarce, pawnshops provided alternative mechanisms for economic activity that helped communities survive until normal commerce could resume. The seasonal nature of medieval economic life made pawnshops even more valuable. Agricultural societies experienced predictable cycles of abundance and scarcity that created regular financial pressures for most families. The period between harvests was particularly challenging, as stored food dwindled and cash became scarce just when many expenses were greatest. Pawnshops allowed families to smooth out these seasonal variations by pawning goods during difficult periods and redeeming them when circumstances improved. But pawnshops served functions far beyond individual emergency lending. They provided crucial working capital for small businesses and craftsmen who lacked access to other forms of commercial credit. A weaver might pawn household items to purchase raw materials for a large commission, then redeem them when the finished work was sold. A merchant could pawn valuable goods to raise cash for a trading expedition, using the profits to reclaim his collateral upon return. This role as a provider of working capital was particularly important for England's growing craft industries. During the 13th and 14th centuries, specialized production of everything from textiles to metalwork was expanding beyond the traditional guild structures that had historically controlled commercial credit. Independent craftsmen and small entrepreneurs needed flexible, accessible financing that established institutions were unwilling or unable to provide. Pawnshops filled this gap, offering credit based on assets rather than social connections or institutional membership. The impact on women's economic activities was especially significant. Medieval law and custom severely restricted women's access to most forms of credit and commercial finance. Banks and major lenders typically required male guarantors or cosigners that many women couldn't provide. Pawnshops, however, accepted collateral regardless of the gender of the borrower, creating economic opportunities that were otherwise unavailable. Women could pawn their jewelry, clothing, or household goods to raise capital for trading activities, to support their families during widowhood, or to survive economic crises without male protection. Even more remarkably, pawnshops created a form of economic democracy that was revolutionary for its time. Unlike other medieval institutions that reinforced social hierarchies and economic stratification, pawnshops dealt primarily with the intrinsic value of collateral rather than the social status of borrowers. A peasant with a silver cup could receive the same consideration as a minor noble with similar collateral. This merit-based approach to credit allocation helped break down some of the rigid economic barriers that characterized medieval society. The economic effects extended beyond individual transactions to influence broader commercial patterns and regional development. Areas with well-established pawnshops often experienced greater economic stability and growth than regions that lacked such institutions. The availability of emergency credit encouraged entrepreneurship and risk-taking that might otherwise have been impossible. Merchants were more willing to undertake ambitious trading ventures, knowing that temporary setbacks could be managed through pawn borrowing rather than resulting in complete financial ruin. Pawnshops also played crucial roles during larger economic crises that affected entire regions or social classes. The periodic wars that characterized medieval England created enormous disruptions in normal economic life, displacing populations, destroying property, and interrupting trade networks. During these upheavals, pawnshops often represented the only functioning financial institutions, providing emergency services when banks closed and traditional credit networks collapsed. The relationship between pawnshops and royal finances deserves special attention, as it illustrates how even the highest levels of medieval society depended on these institutions. English monarchs regularly pawned crown jewels and other royal treasures to finance military campaigns, diplomatic missions, and other state activities. Edward III famously pawned the royal regalia to Lombard lenders in 1338 to raise funds for his wars in France, while Henry V repeated the practice in 1415 to finance the campaign that culminated in the Battle of Agincourt. These royal transactions weren't simply matters of convenience. They reflected the fundamental limitations of medieval state finance. Kings had no reliable mechanisms for borrowing money against future tax revenues, no central banks to provide emergency financing, and no sophisticated capital markets to tap during crises. Pawnshops offered the only practical solution for raising large sums quickly, when diplomatic or military necessities couldn't wait for traditional fund-raising methods. The economic ripple effects of pawnshop operations extended throughout medieval communities in ways that are easily overlooked but were profoundly important. When pawnshops made emergency loans available, they prevented the economic disruptions that could cascade through interconnected local economies. A farmer who avoided bankruptcy through pawn borrowing continued to purchase goods from local merchants, pay wages to agricultural workers, and meet obligations to landlords and tax collectors. The entire community benefited from this economic stability, even if most people never directly used pawn services. Similarly, the sale of unredeemed pledges created secondary markets that provided economic benefits throughout society. These sales offered opportunities for people to purchase goods at reduced prices, from everyday necessities to luxury items that might otherwise be unaffordable. The resulting circulation of goods helped ensure that valuable items remained in productive use rather than being hoarded by wealthy elites or lost to economic disruption. The geographic distribution of pawnshops also influenced regional economic development in important ways. Areas with good access to pawnshop services often attracted entrepreneurs and skilled craftsmen who valued the financial security that emergency credit could provide. Market towns with established pawnshops became preferred locations for commercial activities, as merchants and traders appreciated having access to flexible financing arrangements. Perhaps most importantly, pawnshops provided economic hope in a world where hope was often in short supply. They offered people facing desperate circumstances a way to survive crisis without permanently sacrificing their material heritage or social status. A family forced to pawn treasured possessions during bad times could look forward to redeeming them when circumstances improved, maintaining both their physical assets and their psychological connection to better days ahead. The documentation of pawn transactions also contributed to the development of more sophisticated accounting and record-keeping practices that would influence medieval commerce more broadly. Pawnshop ledgers provided models for systematic business records that were adopted by other types of merchants and eventually contributed to the development of modern bookkeeping systems. Yet for all their economic benefits, pawnshops also created new forms of economic dependency and social tension that would become more apparent over time. The high interest rates they charged, while justified by the risks and costs of their operations, sometimes trapped borrowers in cycles of debt that were difficult to escape. The convenience of pawn borrowing could encourage people to rely too heavily on this form of credit rather than addressing underlying economic problems. As we have seen, the economic role of medieval pawnshops extended far beyond simple money lending to encompass crucial functions in liquidity provision, working capital finance, economic stability, and social mobility. But like all powerful institutions, they also attracted criticism, fraud, and scandal that would ultimately influence their development and regulation. Chapter 4: Scandals and Fraud. Medieval pawnshops did charge substantially higher rates than other lenders, often between 20% and 40% annually, rates that modern observers would certainly consider predatory. Pawnbrokers justified these rates by pointing to the unique risks and costs of their business, the expense of secure storage, the difficulty of valuing diverse collateral, the losses from theft and deterioration, and the administrative complexity of managing thousands of individual transactions. But critics argued that these high rates trapped desperate people in cycles of debt that were nearly impossible to escape. They pointed to cases where borrowers had paid more in interest than they had originally borrowed, yet still faced the loss of their collateral if they couldn't meet increasingly expensive redemption costs. Some pawnbrokers were accused of deliberately encouraging customers to extend loans repeatedly rather than redeeming their goods, maximizing interest income at the expense of customer welfare. More serious still were accusations of outright fraud and deception in the evaluation and handling of pawned goods. Pawnbrokers possessed enormous advantages over their customers in knowledge of market values, quality assessment, and commercial practices that could be exploited to cheat unsuspecting borrowers. A pawnbroker might deliberately undervalue pawned goods, lending a fraction of their true worth, and then profiting enormously when unredeemed items were sold. Alternatively, they might switch valuable items for inferior substitutes, returning worthless goods to customers who couldn't distinguish between authentic and counterfeit articles. The problem of stolen goods presented another recurring source of scandal and legal difficulty. Medieval law enforcement was primitive by modern standards, making it relatively easy for thieves to dispose of stolen property through pawnshops. pawnbrokers faced the difficult challenge of distinguishing between legitimate customers and criminals, while handling enormous volumes of diverse goods with limited time for investigation. Honest mistakes were inevitable, but critics accused some pawnbrokers of deliberately accepting stolen goods, either through willful blindness or active collaboration with criminal networks. The case files of medieval courts reveal numerous instances where pawnbrokers were accused of receiving stolen property, from household goods and clothing to valuable religious artifacts and royal possessions. These cases often involved complex investigations that required pawnbrokers to prove the legitimacy of their transactions, while accusers demanded the return of allegedly stolen goods. The legal proceedings could drag on for years, destroying reputations and business relationships while leaving the underlying questions unresolved. Document forgery represented another area where medieval pawnshops became entangled in broader patterns of financial fraud that characterized the period. The complex legal structures that pawnbrokers used to comply with usury laws required extensive documentation that could be manipulated or counterfeited by unscrupulous operators. Fake pawn tickets, altered loan agreements, and fraudulent records of collateral evaluation were all used to cheat customers or evade legal restrictions on pawnshop operations. The literacy gap between pawnbrokers and their customers created additional opportunities for exploitation. Since most medieval people couldn't read or write, they depended on pawnbrokers to accurately record the terms of their transactions and properly maintain the documents needed for redemption. Unethical operators could take advantage of this dependency by recording loan amounts or interest rates different from what had been agreed upon, knowing that illiterate customers would have no way to detect or prove the fraud until it was too late. Political and economic crises often triggered waves of anti-pawnbroker sentiment that mixed legitimate grievances with scapegoating and xenophobia. During periods of economic hardship, pawnbrokers made convenient targets for popular anger about conditions that were typically caused by much broader forces. Their visibility, their foreign origins in many cases, and their association with unpopular practices like money lending made them natural focal points for communities seeking someone to blame for their troubles. During economic downturns or political tensions, pawnbrokers faced accusations of price manipulation, hoarding of goods, and collaboration with enemies of the realm. These charges were often based more on popular prejudice than factual evidence, but they could result in serious legal consequences, including confiscation of assets, imprisonment, and permanent banishment from trading. Royal attitudes toward pawnshops reflected the same ambivalence that characterized broader social opinion. While monarchs regularly used pawnshop services for their own financial needs, they also periodically cracked down on the industry when political circumstances made such action expedient. Edward III, who had pawned the crown jewels to finance his French wars, later imposed restrictive regulations on pawnbrokers as part of broader economic reforms. Henry VII actively harassed Lombard pawnbrokers despite his own financial dealings with them, responding to popular pressure while simultaneously benefiting from their services. These royal interventions often involved allegations of fraud and abuse that may have been politically motivated rather than factually based. Pawnbrokers made useful scapegoats for economic problems that were actually caused by royal financial mismanagement, military expenses, or monetary policies. By blaming pawnbrokers for high interest rates or economic instability, monarchs could deflect criticism from their own actions while appealing to popular prejudices about foreign merchants and money lenders. One particularly dramatic example occurred in 1311, when the Council of Vienne declared belief in the legitimacy of usury to be heretical, potentially subjecting pawnbrokers to prosecution by the Inquisition. While this extreme position was never consistently enforced, it created legal uncertainties that plagued the industry for generations. Pawnbrokers could never be entirely certain that their carefully constructed legal arrangements would protect them from charges of heresy or usury, making them vulnerable to both theological criticism and legal persecution. The internal culture of pawnshop operations also contributed to scandal through practices that, while not necessarily illegal, struck many contemporaries as morally questionable. The auction sales of unredeemed pledges, for example, often created situations where desperate former customers were forced to watch their treasured possessions sold to strangers for fractions of their sentimental value. These scenes provided powerful imagery for critics who argued that pawnshops destroyed social bonds and family heritage in pursuit of commercial profit. Competition between pawnbrokers sometimes led to practices that bordered on fraud or extortion. In markets with multiple operators, some pawnbrokers attempted to steal customers by offering better terms initially, then trapping them with hidden fees or deliberately complicated redemption procedures. Others engaged in price fixing or territory division agreements that eliminated competition and allowed them to charge excessive rates without fear of customer defection. The international networks that connected Lombard pawnbrokers across Europe also created opportunities for large-scale fraud that transcended local jurisdictions and law enforcement capabilities. A dishonest operator could accept valuable collateral in one location, then disappear to another country before customers attempted redemption. Complex financial instruments and credit arrangements between different branches of the same merchant family could be manipulated to hide losses, inflate profits, or evade local regulations and taxation. Modern historians studying medieval pawnshops face the challenge of distinguishing between legitimate criticism and unfair persecution, between actual fraud and politically motivated accusations. The surviving documentary evidence is often biased, consisting largely of legal proceedings, moral complaints, and regulatory attempts rather than routine business records that might present a more balanced picture of industry practices. The most honest and ethical operators rarely generated the kind of dramatic records that survive in archives, while the most scandalous cases received attention far out of proportion to their actual frequency. What seems clear is that medieval pawnshops, like all financial institutions operating in complex and changing regulatory environments, attracted both honest operators trying to provide legitimate services and unscrupulous individuals looking to exploit regulatory gaps and customer vulnerabilities. The high profits available in the industry, combined with the legal complexities of operating within usury restrictions, created incentives for creative and sometimes fraudulent business practices that periodically erupted into public scandals. These scandals had lasting effects on the development of financial regulation and public attitudes toward money lending that would influence European economic development for centuries to come. The periodic crackdowns on pawnshop abuses contributed to the evolution of consumer protection laws, interest rate regulations, and licensing requirements that attempted to balance the economic benefits of credit availability with the social costs of predatory lending practices. Yet despite all the scandals and criticisms, pawnshops survived and continued to serve essential economic functions that no other medieval institution could provide. Their persistence through repeated waves of moral panic and regulatory restriction testifies to the fundamental importance of the services they offered to communities that had no alternative sources of emergency credit or flexible finance. Chapter 5: Legacy in Finance. As our journey through the shadowy world of medieval pawnshops draws to a close, we find ourselves standing at the threshold of modern finance, looking back at institutions that seem both primitive and startlingly familiar. For the legacy of England's medieval pawnshops extends far beyond their immediate time and place, weaving threads of financial innovation through centuries of economic development to reach even our contemporary world. Consider this remarkable fact. Many of the fundamental principles that govern modern banking, consumer finance, and risk management were first developed not in the marble halls of Renaissance banks or the counting houses of merchant princes, but in the modest shops marked with 3 golden spheres where desperate people brought their treasures in exchange for survival. The sophisticated loan systems, customer service practices, and regulatory frameworks we've explored weren't just historical curiosities. They were the prototypes for financial institutions that continue to shape our lives today. The most obvious legacy lies in the continued existence of pawnshops themselves, which have survived virtually unchanged in their basic operations for over 7 centuries. Modern pawnbrokers still evaluate collateral, extend secured loans, charge interest rates that reflect their operational risks, and sell unredeemed pledges according to procedures that would be immediately recognizable to their medieval predecessors. The 3 golden spheres still mark pawnshop locations around the world, maintaining an unbroken symbolic connection to the Lombard merchants who first established the industry in medieval England. But the influence of medieval pawnshops extends far beyond their direct institutional descendants. The concept of collateralized lending that they perfected became a fundamental principle of banking that underlies everything from modern mortgages to commercial credit lines. When you use your house as security for a loan, or when a business pledges inventory as collateral for operating capital, you're participating in financial mechanisms that were essentially invented by medieval pawnbrokers dealing with craftsmen's tools and merchants' goods. The risk assessment techniques developed by Lombard pawnbrokers also prefigured modern credit analysis and underwriting practices. Medieval pawnbrokers learned to evaluate not just the immediate value of collateral, but its likely marketability, durability, and liquidity under various economic conditions. They developed procedures for diversifying risk across different types of assets and customer bases, techniques that remain central to modern portfolio management and financial planning. Perhaps even more significantly, medieval pawnshops pioneered the democratization of credit that characterizes modern consumer finance. While earlier forms of lending had been limited to wealthy merchants and landed elites, pawnshops made credit available to ordinary people based solely on their ability to provide adequate collateral. This principle of merit-based rather than status-based lending would eventually transform into the credit scoring systems and asset-backed lending that dominate contemporary finance. The documentation and record-keeping practices developed by medieval pawnbrokers also contributed to the evolution of modern accounting and financial administration. The detailed ledgers that recorded each transaction, the systematic procedures for tracking collateral, and the standardized forms used for customer transactions provided models for business record keeping that influenced commercial practices far beyond the pawnshop industry itself. The legal frameworks that emerged around medieval pawnshops established precedents for consumer protection and financial regulation that continue to influence modern law. The rules governing maximum interest rates, minimum holding periods for collateral, and procedures for disposing of unredeemed goods all reflected attempts to balance the legitimate needs of lenders with protection for vulnerable borrowers. These same tensions continue to shape modern debates about payday lending, credit card regulation, and consumer finance protection. The international networks developed by Lombard pawnbrokers also prefigured the globalization of modern finance. The ability to coordinate transactions across multiple locations, share information about customers and market conditions, and manage risk on an international scale required innovations in communication, documentation, and financial control that would later be adopted by banks, trading companies, and eventually multinational corporations. Medieval pawnshops also pioneered many of the customer service practices that modern financial institutions take for granted. The emphasis on speed and convenience, the standardization of procedures to reduce confusion and error, the development of transferable instruments like pawn tickets, and the creation of redemption processes that protected both lender and borrower interests all reflected sophisticated understanding of customer needs and market dynamics. The economic functions that medieval pawnshops served have been largely absorbed by other institutions in modern economies, but their legacy remains visible in many contemporary financial services. Payday lenders, title loan companies, and other forms of alternative finance operate according to principles that were essentially established by medieval pawnbrokers. Even mainstream banks offer secured credit lines and asset-based lending that follow procedures developed centuries ago by Lombard merchants. The social and cultural legacy of medieval pawnshops is perhaps even more important than their technical innovations. They established the principle that financial services should be available to ordinary people facing emergency situations, not just to wealthy elites conducting large commercial transactions. This democratic approach to finance helped create expectations about credit availability that would eventually lead to the development of comprehensive consumer banking, government-sponsored emergency aid programs, and social safety nets that take for granted the idea that financial help should be available to those who need it most. The moral and ethical debates that surrounded medieval pawnshops also prefigured many contemporary discussions about financial regulation and social responsibility. The tension between providing essential services and avoiding exploitation of vulnerable populations remains central to modern debates about predatory lending, consumer protection, and the social obligations of financial institutions. Even the scandals and frauds that periodically plagued medieval pawnshops provided important lessons that influenced the development of modern financial oversight and regulation. The recognition that powerful financial institutions could exploit information advantages and regulatory gaps to cheat customers led to the development of licensing systems, disclosure requirements, and enforcement mechanisms that remain fundamental to contemporary financial regulation. The geographic and urban development patterns influenced by medieval pawnshops also left lasting marks on modern cities. The concentration of financial services in particular districts, the integration of lending institutions with commercial markets, and the relationship between financial services and economic development all reflected principles established by medieval pawnbrokers. Modern financial districts around the world still show the influence of medieval patterns that concentrated related businesses in specific locations to facilitate information sharing and reduce transaction costs. The influence of medieval pawnshops on literature, culture, and social attitudes toward money and commerce should not be overlooked either. They provided settings and inspiration for countless stories, plays, and moral tales that shaped popular understanding of finance and economic relationships. The figure of the pawnbroker became a stock character in European literature, representing both the necessity and the moral complexity of commercial relationships in ways that continue to influence contemporary cultural attitudes toward lending and debt. Modern microfinance and development economics have also drawn explicitly on the medieval pawnshop model as they seek to provide financial services to underserved populations in developing countries. The recognition that poor people need access to credit and that collateral-based lending can provide such access without requiring extensive bureaucratic infrastructure has led to programs around the world that consciously emulate medieval pawnshop practices adapted to contemporary conditions. The technological innovations that medieval pawnshops developed for storage, security, and transaction processing also contributed to broader advances in business operations and facility management. The iron safes, elaborate numbering systems, and systematic approaches to inventory control that they pioneered were adopted by other industries and eventually contributed to the development of modern warehousing, logistics, and information management systems. Perhaps most remarkably, the basic business model of medieval pawnshops has proven remarkably durable and adaptable to changing economic conditions. While the specific goods that serve as collateral have changed from medieval tools and textiles to modern electronics and jewelry, the fundamental transaction of exchanging immediate cash for temporary possession of valuable goods continues to meet essential customer needs that other financial institutions cannot or will not address. The regulatory frameworks that govern modern pawnshops in most developed countries still reflect principles and procedures that were first established in medieval England. Maximum interest rates, licensing requirements, record-keeping obligations, and procedures for disposing of unredeemed goods all echo medieval attempts to balance the legitimate needs of lenders with protection for borrowers and prevention of fraud. Looking toward the future, the lessons of medieval pawnshops remain relevant for contemporary efforts to expand financial inclusion and develop alternative forms of credit for underserved populations. Their success in providing accessible, flexible credit to people who lacked access to mainstream financial institutions offers insights for modern attempts to address similar challenges in developing countries and marginalized communities. The environmental consciousness of medieval pawnshops, which kept valuable goods in productive circulation rather than allowing them to be wasted or hoarded, also provides a model for contemporary efforts to develop more sustainable approaches to consumption and resource use. The circular economy, principles that they embodied centuries before such concepts had names, offer inspiration for modern attempts to reduce waste and maximize the useful life of manufactured goods. As we conclude our exploration of medieval pawnshops, we can see that their legacy extends far beyond the simple provision of emergency loans to desperate individuals. They pioneered financial innovations, established regulatory principles, created customer service standards, and developed business models that continue to influence modern finance in ways that are both obvious and subtle. Their story reminds us that some of our most sophisticated contemporary institutions have roots in the practical wisdom of people who were simply trying to help their communities survive in a dangerous and uncertain world. The three golden spheres that still mark pawnshops around the world serve as more than just business symbols. They're monuments to human ingenuity, community resilience, and the enduring power of financial innovation to improve people's lives. From the desperate medieval mother pawning her silver brooch to feed her children to the modern entrepreneur using title lending to finance a new business, the essential human needs that medieval pawnshops addressed continue to drive financial innovation and economic development in our own time. Now, as we settle into sleep after our long journey through medieval England's financial landscape, we can rest knowing that we've witnessed not just history, but the birth of institutions and ideas that continue to serve human needs centuries after their creation. The pawnshops that saved medieval lives established patterns of financial service and community support that echo through time, reminding us that the most enduring innovations are often those that address the most basic human needs for security, opportunity, and hope in times of crisis. Remember to subscribe if you've enjoyed this journey through medieval finance, and let me know in the comments what aspects of pawnshop history surprised you most. Until next time, sleep well knowing that even in the darkest periods of history, human ingenuity found ways to help communities survive and thrive.